something, some brand new crazy product we haven't talked about that is actually designed to deceive or is designed to break something in the system. If we don't have regulators to step in there.
All right, joining me will be Dave Nadig, President and Director of Research at ETF.com, who, of course, is a leading independent resource for all things ETFs. News, analysis, they have a ton of ETF data and research tools. And Dave himself really needs no introduction. We're talking about a longtime industry veteran going back to the earliest days of ETFs. And he will laugh, but I always say, I'm not sure there's anyone walking the face of this earth who knows more about ETFs than Dave does. He's always one of my favorite people to visit with. And so we are just going to jump around on a variety of topics. So I will say many of these tie into ETF innovation and regulation and really the current state of the industry overall. I would say, especially given this parade of products coming to market that look much more like gambling vehicles, speculation vehicles than investment vehicles. So I'll start there this week, and then I'll be joined by Paul Baiocchi, head of fund sales and strategy at SS&C ALPS Advisors, who's a $22+ billion ETF issuer. And we're also going to spend a few minutes just picking up on the conversation I'll have with Dave, because I'm very curious to get an ETF issuer's take on some of this as well, just in terms of this blurring of lines between investing and gambling, and whether some of the quote unquote innovation we're seeing in the industry is actually good, or whether it's sort of sucking the oxygen out of the room for issuers who are offering real value added products. So that should be interesting. And then Paul is also going to highlight 3 key market themes to watch in the third quarter. And we'll talk about some of the ALPS ETFs that could be impacted. As always, questions or comments, you can find me on X at Nate Geraci, or you can go to etfprime.com. So first up is ETF.com's Dave Nadig, who is joining me from Massachusetts. Dave, I have to tell you, it is so great to have you back on here. Welcome back to the podcast.
Well, it's great to be back. And boy, a whole lot of things have happened in the last few months, huh?
Well, it's it's funny. I thought when you were going to come on here, we should harken back to the good old days when you and I would just jump around on a bunch of different ETF topics that have no rhyme or reason. I think that's always the best format for us. And so I think I have 8 or 10 different topics. I'm not sure if we'll get to them all, but here's what I'm going to do. You know the drill here. I'm going to start teeing these up. You give us your hot take, and we'll see where that takes us, if all that sounds good to you.
Let's roll.
All right. So you're going to like this right off the bat. First topic, which I know is right in your wheelhouse, and I have a feeling this will get you animated very early here as well. So I want to ask you about this request for public comment that the SEC recently put out on novel ETFs, where essentially they're seeking feedback on how new products come to market, right? Everything from what the approval process should look like to the possibility of confidential ETF filings. And I don't want to put words in your mouth, but my sense, just from following the work that you do, is that you think this is just another way to loosen up regulation. I think you have some concerns about what ETF regulation looks like right now. So 2 questions for you. First, what is the current state of ETF regulation? And then 2, what, if anything, might this request for comment accomplish?
So I actually think the current state of the rules, like all the stuff we wrote down about how the system's supposed to work, is pretty great, honestly. Like 6C11, the ETF rules, solved most of the problems the industry had. Most of the little tweaks we've done along the way, most of the discussions around crypto and what we're doing in the legislative part of that process, like that's all. I mean, yeah, we could argue about whether we want things approved faster and whether things are too slow, but that's a good process, and that all seems to be working. The challenge is enforcement, right? So like I think the thing we have to recognize is 2 years ago we had fully functioning financial regulators. Everything was fully staffed, every job had a body in it, the rulemaking process ran on time. Now we have effectively no CFTC. We have a single commissioner, so they can't even have a meeting to discuss rulemaking or anything like that. The SEC drops below quorum in November when Hester leaves, right? So that will rapidly become a complete, they can't even have a meeting again to discuss rulemaking at the SEC starting in November. There's been no movement to do anything about that. So like there's an intentional strategy by the administration to de-staff the heads of all the financial regulators. That's concerning. I feel like that should be concerning to everybody in the financial markets because that's the backstop for malfeasance, right? Some bad actor, some Madoff. I don't know. Can we come up with somebody people still agree is a bad guy in the financial markets? I think we pardoned everybody, but like an actual bad guy who's just stealing money from widows and orphans, the backstop is the regulator, right? That's who sends the enforcement division out. They make recommendations to the DOJ if there's criminal filings. I mean, there's a whole process. None of that's happening. We've just abandoned all of that. So enforcement is absolutely collapsed. Staffing's down roughly 20% across all of both of those agencies. And so we're heading towards effectively a deregulation by defunding world. So the RFC lands in that context. So if we took the RFC completely out of that context and just said, well, what questions is the US financial regulator asking? It's very reasonable. They're asking the industry questions about whether the process is working well, whether there should be different gates or different timings for things that are more complex. Those all sound very rational. And in fact, Brian Daly hopped on Eric Balchunas' podcast, I think 2 or 3 weeks ago, right before I went on vacation, and said all the things you would expect them to say about, well, this is industry consolidation and we're trying, or consultation, we're trying to make sure that we have a good path for innovation. Things are moving fast. But the backstop of that is they're understaffed. So that if you've got 20% fewer people reviewing filings and you're expecting the industry to grow, you have a capacity problem. So to me, it was very clear, and to a lot of the lawyers I've talked to, it's been pretty clear. The RFC is actually cover for a fast track process that requires less SEC staff oversight by creating some process gates things can go through. Personally, I don't think that's great because I don't think that the problem with US financial markets is that we've been way too restrictive on what gets launched. That I just don't see that as the problem needing to be solved. So I'll take a step down from my high horse there. But like that to me is really the issue. It's staffing and enforcement, not the rules themselves.
First of all, I knew I was going to get you fired up right off the bat, so I'm very pleased with that. But let me ask you this: for the ETF industry, though, what are some of the potential negative ramifications of everything you just described? If we're not fully staffed on the enforcement side, and let's just say understaffed overall, maybe there's not enough focus here. What are some of the potential negative implications of that for ETF specifically?
So at some point either something breaks or something bad happens, i.e. somebody intentionally does something to break things to profit. uh, that's the risk. And if you're, I'm not concerned that tomorrow morning BlackRock and Vanguard are going to wake up and decide to play fast and loose with the rules, right? I feel fairly confident they're going to sort of methodically push the edge of the envelope. That's not the issue. The issue is some upstart who comes out with something that I don't know what it is. And I don't want to cast aspersions on products that don't exist, but some new product, 10x leverage, prediction market, whatever, volatility hedging, something, some brand new crazy product we haven't talked about that is actually designed to deceive or is designed to break something in the system. If we don't have regulators to step in there, that could cause problems for the entire ETF industry. First, I mean, obviously there's a taint issue, right? If you have a Madoff-like moment in an ETF, that will taint ETFs for a whole class of investors. I'm not too worried about that. I think ETFs are pretty much here to stay. I don't think they're going to go anywhere. But it is a black eye problem, and worse, it could drive the entire retail industry back into non-innovative products. So all these innovations we're trying to get into retail, by letting everybody run fast and loose, what we're actually doing is increasing the likelihood we have a big blow up event and everybody runs the other direction and you can never get anybody out of 3 basis points by again.
All right. Well, let's do this. Let's talk about the current state of innovation, and then maybe we can come back to what you're saying if we play this forward. And, Dave, I feel like you have always been someone who has championed ETF innovation. As long as I've known you, you've talked about the power of the ETF wrapper and its ability to democratize access for investors. But As I was thinking about this, the innovation that you and I used to cover back in the day, that was things like straightforward commodity ETFs, smart beta, active bond ETFs. That was the innovation. Today, the innovation seems largely geared around products, at least from my perspective, that look much more like pure gambling vehicles, as I was mentioning at the top. These are basically lottery scratch off tickets. And so I'm curious how you feel about that as somebody who you clearly love the ETF wrapper, but maybe you don't love what's now being put inside of it.
Yeah, I think that there are things that don't necessarily belong in an ETF wrapper, not because of some moralization about who should get access, but just structurally. Leveraged to me is the big one. We've had it massive launches of 2x, and some we already had the 3x leverage. Not just in the U.S., there was a massive issue in South Korea. They had to actually shut down leverage products in South Korea because they were definitely the tail wagging the dog. So we've had like all of this focus on leverage, and it's all showing up in the ETF format. Meanwhile, Kalshi's trading perpetuals, which is a vastly superior mechanism for getting speculative leverage, right? It's adjustable. You know what your funding rates are. There's no hidden fee that disappears in a swap counterparty. You don't have to worry about the crypto rate. I mean, the TradFi rails going hinky at 3:30 in the afternoon as everybody's trying to trade the close. Like it's simply a better technology. And because of what we're doing in ETFs now, we're not actually driving those folks where they should be. Like, I'm not anti gambling, I'm not anti speculation. I would just like those activities to be in the correct framework, right? So put the sports gambling on sports gambling platforms, put the leverage stuff on leverage defined platforms like perpetuals. Great, that's awesome. Then we can contain it, we can regulate it, we can monitor it, we can see whether it is a problem by loading it into every single ticker you have to look at on your Schwab terminal or Bloomberg terminal. We're just polluting US equity market structure with a whole lot of speculative stuff that it has better existing tech rails for.
So, just to be clear, I mean, it sounds like you might be saying a line should be drawn somewhere in terms of what can be wrapped in an ETF. And you look right now, we literally have a filing for a sports betting ETF. But I think, just to be fair, some would make the argument as long as the product does what it says it's supposed to do and there are proper risk disclosures, then ultimately it's up to the investor to decide what they want to invest or gamble with, right?
Yes, except that disclosure is great if you're going to enforce bad disclosure,
So that
which
gets
we are
back to
no
your
longer
point
doing at
earlier.
all, right? So if it was the case that we had a clear set of rules that said, hey, you can't let your Robinhood, I'm picking on them not because they've done a thing, but top of my mind, your trading app allows 16-year-olds to trade sports contracts, and that's against the rules, and you should have disclosed this was not available for people under 18, and you should have disclosed all this. Like, if we were going to hold people to a high level of actual know your customer level disclosure and then like actually enforce those rules and send people to jail for breaking them, great. But we're not doing anything like that. So I'm all about a full and fair, full disclosure regime if we enforced it. But we're not only are we not enforcing it, we're going the other direction. I mean, by the time I'm on the show again, I feel fairly confident we won't have quarterly reporting anymore, despite 200,000 comments overwhelmingly supporting quarterly reporting. The SEC is going to yank it. Like, that's the world we're in. We're going to a lower transparency, lower effective disclosure environment.
Should ETF issuers be doing anything different here? Or do you like you get it? We have much looser regulation. Clearly, issuers can see that. Issuers know that some investors do like to gamble. And so this is all capitalism, right? Issuers are just trying to make money. And so all of this sort of is what it is. Or do you think issuers should have more responsibility here? That maybe they see there's looser regulation and they should be doing something differently
Well,
to
look,
make sure they're holding themselves out to the market in a certain manner.
should is a real big word there, Nate. Like, because should, like, do I, like, from a moral, like, I happen to be a Christian, I think it should go this way. Like, that's not the relevant conversation. So should here is a big thing. I think there's the opportunity for individual issuers to build brand fighting against some of this, and you can see some issuers doing that. I think that's just smart. Certainly, issuers who have concerns should be talking to their regulators about those concerns. And I know a lot of them aren't. They're just sort of sitting back and watching. That's their choice. They're allowed to do that. As you point out, this is just capitalism, and to some extent, it's not the job of the competitor in the marketplace to self-regulate against their own economic best interest. So, no, I don't really think the issuers should be doing something differently here. That doesn't mean I can't look at an individual issue or an individual product and point at it and say that is a bad product, and the people who are launching this do not care that they're hurting people. That is absolutely happening, and I can have my own personal vitriol against that, but that is very different than me saying that I think the industry should do a thing.
No, that's fair. I think it gets back into what you've always talked about, which is this concept of trust around ETF issuers, and that, yeah, issuers can do what they want as long as they're operating within the law, whatever that law or the regulation currently looks like. But as investors and advisors, you have a decision to decide who you trust and who you want to do business with. And to your point, maybe issuers do have an opportunity right now to differentiate themselves in this environment.
Yeah, and I think I talking to advisors, I think that that message has actually happened. Now, some of it may just be, we had a little bit of a pullback, we've had a war, we've had some of the big high profile balloons like MicroStrategy really get deflated. So some of the craziest stuff already had a bunch of air let out underneath it. And I think that that's very healthy. And I think advisors have largely used most of this market volatility as an opportunity to get closer with their clients. This hasn't been the kind of crazy speculative whipsawing that drives a lot of customers into advisor shops saying, "Why am I not in triple leverage MicroStrategy?" I mean, that's not the real world.
Before we move on here, because I do want to get to some fun topics, maybe move on from the regulatory and morality discussion. How does this all resolve itself? I mean, is this, and I don't want to head down the political path, but I think you and I would both agree that the political pendulum swings back and forth, every whatever, 4 or 8 years. And so maybe we're just an environment where it is much more, deregulation and things are running a little fast and loose. Is the resolution that maybe that pendulum swings back, or is there something else that you would like to see happen here?
I mean, certainly in 2.5 years, when we actually potentially are changing like who's in charge of things, either individuals at different regulators or the president. Sure, you can imagine a swing back there. And hey, there are pieces of that I would root for. I actually think the CFPB did some decent work. Do I think it needed all the money it had? No. Do I think it actually helped millions of actual customers? Yes. So like, there's lots of pieces I would be like, yeah, we should grab that back. We should grab that back. I don't get to make the rules. So the reality is we're going to be in this heavily deregulated environment. The deregulation is going to be primarily because of disenforcement, not because we actually cut a rule. We're going to say we don't care about a rule anymore. That's a tricky place for an issuer to lean in, right? If we're saying, well, we're just not going to enforce that rule for 2.5 years, that's not a guarantee that 3 years from now somebody's not filing a lawsuit against you, and it's not necessarily protecting you when your shareholders sue you because something goes wrong. So I think that despite that deregulatory space we're going to be in, I don't expect a lot of abuse of it by the big actors in the space, precisely because everything is temporary, right? There's no permanence to any of these shifts. So we're seeing all those little edges push out. Thousands of products will get launched. I suspect the prediction market stuff will probably get delayed at least another quarter or two, but I do think it's somewhat inevitable. There's so much pressure, and Selig has been very clear he's going to make it happen. Like, he's individually driving this, and there's nobody to stop him because there is no commission.
All right. So right now, your message is investor beware, right?
Yep.
Advisor beware.
Yep.
Okay. Let's move on to a few what I'm going to call lighter topics.
Thank you.
And we
Please, for the
started
love
pretty
of
heavy
God.
there. All right. I think you'll like these. So first, I have to ask you about this new issuer Corgi, which I don't know if you know this. I
Oh,
was looking this morning. Listen to this. Corgi is already the third largest issuer in the country by number of ETFs. And as
yeah.
you know, they really just started coming to market a couple of months ago. They had a handful of products towards the end of last year, but the vast majority of these have been in the past couple of months.
Yeah.
And they're just peppering the board with new ETFs and also filings. Dave, again, you've been in this industry since the earliest days. We've never seen anything like this in the ETF space before. So do you think this strategy can work?
Oh, absolutely. I 100% think it can work. Look, I'm not a fan of every product these guys are launching, like 2x whatever and inverse whatever, and like they are beyond the spaghetti cannon. They are their own meme at this point in terms of what they are throwing against the wall in hopes it sticks. What I love about Corgi is it's a bunch of people from outside the industry, largely, who found a cash flow niche business in insurance, like AI based insurance underwriting and distribution. Great. Like, awesome. Bunch of techies figured out a way to disintermediate the least efficient financial market in the United States. Awesome. So I love where they're coming from already because I hate the insurance market. And the fact that they are then applying that to us to flood the zone with every idea they can, largely to take the money from their own founders, their own friend groups in Silicon Valley, young investors and young entrepreneurs, to create a home for them by giving them the lowest cost option, whether they're crazy day trading speculators or buy and hold, I need my 5 basis point beta. I love the audacity of it. I mean, it's like, it is, pardon my French, just ballsy. And I think that
It's
they're going to get away
unbelievable.
with it.
I love that word audacity. And I don't, I'm not a great marketer, so I don't typically push my podcast on here. But I would encourage everybody to go back and listen. I think it was about a month and a half ago. I had Corgi on this podcast, and it was a fascinating discussion because if you listen to them, first of all, they're a very young company overall. I remember I had Anthony Cranieri on, and he was telling me, most of the people are in their 20s at this
Yep.
company. He said they're working 24/7. They have, a coffee cafe that's open all night long. People are there at 2 in the morning, 3 in the morning, which I can vouch for because when I was coordinating that interview, I was getting emails from them at 2 a.m. in the morning on a Sunday night or Sunday morning. But he said there were a couple of things that stood out to me. He said, one, they are leveraging AI even in the ETF space
Mhm.
where they're looking at, for instance, social media and using AI to help them say, okay, where's investor sentiment? Where is there a lot of interest? And they're launching products into that. He also said that he thinks the industry sort of rested on its laurels, that a lot of issuers sort of are a little greedy with their fee structure. Now we know ETF fees are low. There's products out there for free or 2 to 3 basis points. But his point was like you look in the leveraged ETF space where a lot of products are offered at a point. He said we're going to re-rate this entire space
Yeah,
and
I
offer it
think
at a
they
much more
are.
attractive. And so I like what you said there with audacity because you talk to them and they didn't strike me as arrogant or cocky. They really believe they can do this.
Yeah, and the other thing is that to date so far, I spent a decent amount of time with some of their distribution folks and gotten to know them a little bit. Um, they don't seem to be going against anybody, which I really appreciate. Their message is shockingly positive in a very negative world. They announced just this morning, I think, that they're now going to have an artist in residence who basically sets up in their cafe, and they're just going to pay them. Like, I mean, those are slightly .com-y kind of things to be doing, but by the same token, they're not out there saying fire your advisor, fire Vanguard, get out of that. They're simply saying, hey, here we are, right? And I think the brand is brilliant. I love that they've leaned into all the Corgi memes. Look, there's no question in my mind that a year from now or a year and a half from now, we're going to start seeing 50 Corgi products close a month, right? At some point, somebody's going to be like, all this leverage and inward stuff that's got $3 million and it has to go because it's costing them 50 grand a year to keep it alive. So at some point that comes home to roost. But if in the meantime they get up to 1,500 products and cut the average fee in every class that they compete by 20%, how can you not love that?
Yeah, investors win. And it's
Yeah.
just amazing to me to think, they're disrupting the disruptor. When
Yeah.
I think of somebody disrupting the ETF space, I would think of tokenization or something like that. Here they are coming in, industry's 33 years old, and they're trying to disrupt the status quo.
And they're doing it by building, which I find, like, again, that's part of why, like, I don't know, I spent my 90s in San Francisco in tech company land, right? And I have a real love for people who just want to build stuff from scratch. And you talk to whoever there about, like, how are you handling your options trading, or like what are you going to be doing about your legal situation or whatever, and they're just like, oh, we're just building it all in house, we're hiring people, we're building a trading, like, they're not leaning on 1,000 third-party relationships to have the shell of look, we're actually a real company. And we've seen people do that over and over again. People enter financial services and they rent a bank and they rent a credit card company and they rent an insurance umbrella, and then they try to slap a buzzy logo on it. That was 2010's version of financial disintermediation through the internet. I love that these guys are just building it. So like it's hard not to root for them.
Yeah, I mean, they're fully vertically integrated and yeah, they're going for it. Okay, let me give you 2 more topics. I think both I'll say somewhat related to new launches, and one you were hitting on earlier, but I'd love to have you elaborate a little bit, and that's leveraged ETFs, and I would say in particular single stock leveraged
Mhm.
ETFs, because I feel like I'm seeing a lot more hand-wringing over what might happen if there's a severe market dislocation, and perhaps the role that these ETFs might have in exacerbating that. And I remember you and I have always talked about market structure around these ETFs in the past, and whether ETFs are the tail wagging the dog. Do you have any real concerns here just regarding the explosive growth of leveraged ETFs? We always talk about the pro cyclicality of them and all that, but are these real concerns?
Yeah. So the math remains the math, right? So yes, if a single double daily leverage security is a big enough piece of its underlying, you have problems. We saw that in Volmageddon. We've seen that in the South Korean market, specifically on the two stocks that are getting beat up there, right? So the SK Hynix, et cetera. So we know that the math works in the sense that yes, this can be a real problem. You can get the levered fund wagging the dog into every close and getting crazy volatility right into the end. That is exactly what we saw happening in South Korea, which is why the South Korean regulators had to step in. They had a bunch of their own weirdness in their market structure, which now they're going to have to fix. We did that in 2010, so they're like catching up to us a little bit on some of that. But that's the reality of the world we're in. In the US, none of the single stock ETFs that I've followed are big enough that I'm actually worried about it. That doesn't mean they couldn't be. The big problem isn't a 2x or 3x or even 10x levered SpaceX ETF. The problem is some 2x levered Meredith Corporation ETF, right? The 500th stock in the S&P 500. Nobody day trades at all, right? So all of a sudden, if everybody's day trading Meredith's 2x ETF and there's still no underlying volume and very little volatility in the core stock, that's a huge problem. Now the stock doesn't trade like the stock anymore. It trades like the trading sardine. We haven't seen that right now, but all the pieces are in place. And the more coverage we get from single stock funds, single stock leverage funds, the more likely we'll have one of those outcomes where some name that we're not really talking about because it's a $1 billion mid cap stock is going to get up and down 75% on the day because it's getting wagged at 330 by a rebalance trade. That's the real issue. Not a concern yet, but it could be tomorrow. That's the issue.
What about just the structure of the ETF itself, where we have seen examples of an ETF not being able to get the proper swap exposure, and so then they go into the options market because
Mm-hmm.
banks aren't willing to underwrite the risk. I mean, we
Yeah,
have
yeah.
seen some
So
of that.
there's the underlying markets can be and probably are very stressed. We've been pointing this out since September. There's been this crunch in funding rates, like SOFR. It became 1% over SOFR just to get like overnight S&P exposure, right? So funding rates blew out and have stayed very, very high. And this rise of swap counterparty need for all of these options-based products, all of these leverage-based products, it's a real issue. There are only so many counterparties out there that are willing to take the other sides of these. We've had very specific examples of what happens when this unwinds. The MicroStrategy yield products had this exact problem. I guess it was earlier in this year, maybe it was February, where you could just go through and be like, nope, no swaps, no swaps. And all of a sudden, these very expensive options positions used exclusively to get the leverage, which that's the most expensive way possibly to buy leverage in the entire marketplace. So when that happens, the product has failed. We'll see more of that. Now, to some extent, I don't care because people who are buying those products, they know going in that these are daily products. And if they can't get a swap overnight, you shouldn't be that worried because you should be only owning it one day.
Yeah. How many investors do we think are actually doing
Yeah, I
that?
know.
But it comes back to the message of earlier.
But like,
We are in
I,
an
I don't think
investor beware
those
market.
products won't fail in the sense that they blow up and everybody loses their money. They'll fail in the sense that you'll walk in one day thinking you have 200% exposure to XYZ, and you only have 150% exposure because 25% of the cash is still sitting there and they couldn't lever it. Right. And that's going to happen. And it's going to happen with some frequency as the market crunches in a little bit around liquidity.
All right. I knew we weren't going to get to all the topics I had, but I'm going to give you one more just for old time's sake. And this is not going to surprise you. Let's close with crypto ETFs. You know, I wasn't letting you out of here without talking about crypto ETF. I guess, Dave, I'll just give you the floor here. I mean, is there anything that has your attention, or do you view this all as pretty much yesterday's news?
Oh, well, I mean, to me, the interesting stuff's happening in tokenization. Obviously, the DTCC now has their live test case going on with Qs and SPYs and Microsoft and a bunch of other tickers, and the Canton network with Stellar to follow. Like, that's great. I'm a big fan of the DTCC's project to get actual equity rail tokenization done. I know that's controversial. I know a lot of people in the crypto industry are not a big fan of that because it's sort of slapping lipstick on a pig. I've heard that many, many times about that. I still think it's the only way you actually end up with a regulated quadrillion-dollar trading market is when you actually have the DTCC involved. I don't think you're going to rebuild that in private enterprise. I think at some point you need a backstop. So I love the fact DTCC is doing it. I don't think any of it means numbers go up a lot. That's part of the problem is we're in this sort of plumbing structure part on real world assets and tokenization. And it's really tempting to be like, I should buy XYZ token because it's part of this tokenization infrastructure project. So therefore I should own whatever, Solana, XRP. I mean, pick whatever thing it is you think is going to be the big win. The problem is if we're talking about really bringing TradFi over, nobody's going to tolerate those kinds of giant profit potentials in the infrastructure layer, right? So it's just a little bit like expecting XRP to triple. That's not XRP's job. And therefore, you don't understand what you're buying if that's what you think is going to happen. A lot of the tokenization plays, I feel like, are like that. There's some great investments out there and some venture capitalists are going to make some great money, but there's not just like a token you can buy that's going to moon because everybody wakes up one morning and decides to real world assets are a thing. So it feels like we're maturing as a market. That feels pretty healthy.
How do you think ETF issuers should be viewing tokenization? Is it just another distribution channel and they should be doing homework? We already see some issuers who have done this and they're looking down this path. I'm just curious if you're an ETF issuer out there, what should you be thinking about all this?
I think the media gets this exactly backwards, right? I think that if you're an issuer, where you should be thinking about tokenization is at your biggest, most institutional, giant billions of dollars money moving around problem layer, not at the my customers should have a phone wallet where they can trade my funds, which like there are plenty of people doing that. Wisdom Tree's done that experiment. Like that's a fine model, but the actual value is collateral movement. Like look at what BlackRock's doing. They just published a paper, I think last week on like 30 pages on collateral movement in the ecosystem. It sounds utterly boring. Nobody cares, but that's where tokenization's really going to kick, right? Collateral mobility, which is BlackRock's whole thing, is legitimately where they can extract enormous amounts of efficiency. It doesn't show up as a basis point for a retail investor, so it's sort of pointless. There's not much to extract from the retail side of this business anymore.
Right. It's all the back end plumbing,
Yeah,
to your point. Well, Dave, we'll have to leave it there. This was so much fun.
it was a blast.
Again, great having you back on here. Thank you so much for joining me.
No problem. And let's see whether Paul disagrees with everything I said.
That was Dave Nadig, President and Director of Research at ETF.com.
Navigating the ETF market? Get the precise data and analytics that smart investors rely on. Build a stronger portfolio today at ETFDB.com.
I'm now joined by Paul Baiocchi, Head of Fund Sales and Strategy at SS&C ALPS Advisors, who currently offers 26 ETFs, over $22 billion in assets. And I always say, Paul is simply a fantastic all-around industry resource. He's been involved in the ETF space for well over 15 years now, and I feel like he has a unique ability to talk ETFs, broader asset management trends, financial markets. He can cover it all, and he's now joining me from Denver. Paul, welcome back to the podcast.
Great to see you, Nate. We did it.
We did it. And hey, do you have a favorite area to delve into? Like, do you enjoy talking ETFs more, bigger industry trends, financial markets, or do you feel like this is all tied together and so there's not really a favorite?
Yeah, I don't think you have to partition everything that cleanly, but I do. The sort of old ETF analyst in me loves getting in the weeds on tickers and trends, but as things evolve and because markets are so dynamic, I also love talking asset classes and markets. So to your point, they all converge and it's hard to determine where it ends or where it begins.
Well, this should be perfect because I know ALPS recently published a piece on some key market themes to watch in the third quarter and some ALPS ETFs that could be worth taking a look at here. And we're going to get into those in just a bit. So that'll be perfect in talking ETFs and markets. And then actually, I thought we should start with a few broader ETF trends because you are a fantastic industry resource. And as it turns out, I was just visiting with your old colleague from back in the early ETF.com days, Dave Nadig, which you were there for what, 3 or 4 years back in the early 2010s. Is that right?
I was 2010 to 2014. It's a very sacred part of my career. I learned a lot. I met a lot of people, and Dave, Matt Hogan, all those people were so influential in my career. So I owe a lot to Dave and the ETF.com/index universe crew. For those of you who remember the pre ETF.com days.
Yeah, it's amazing. I do remember that. I was actually talking about Index Universe with somebody yesterday, believe it or not. Very instrumental to the industry overall. I think not just for you, for a lot of people. Okay, so a lot of the conversation Dave and I were having, Paul, centered around ETF innovation and how the regulatory environment has shifted to maybe be a little more loose now. And we were talking about how ETF issuers are launching a lot of products that look more like speculation vehicles, right? There's been this continued blurring of the line between investing and gambling in the ETF world. And I guess for you and I to start, is that something that concerns you as somebody who has been involved in this industry for a while, that we have this parade of leveraged single stock ETFs and crypto ETFs? We have issuers wanting to launch prediction market ETFs, all of those sorts of things coming to market. Is that concerning to you, or how are you viewing this?
Yeah, so I doubt I'll be as cynical on the topic as my good friend Dave might have been, and I don't know what you guys talked about explicitly, but I have a sense of Dave's perspective on this. I like to be a little bit more nihilist on this in terms of let the market determine what is and isn't appropriate. Let the investors, both the retail investors, advisors, institutions, etc., determine what they have appetite for. And I do think that, I harken back to the famous Jay-Z song, Don't Knock the Hustle. There are people in this industry who are trying to bring innovation to the market, and you test, you learn. And I do think that the convergence of gambling and investing that we've seen really, I would argue, since COVID, take hold of the narrative, take shape in the form of market participants and news flow is somewhat troubling because as you know, having been in this industry for as long as you have and service clients for as long as you have, and really lent an academic lens to some of these concepts, the foundational idea of the markets is to invest, to compound, and to grow wealth through investment in companies. And things like prediction markets, leverage inverse ETFs, especially those that are daily reset vehicles, aren't that. They're not investment strategies. They're very much speculation, and they're short-term horizon investments, short dated options, zero duration, all that stuff in many ways ventures into a pocket of capital markets that doesn't necessarily align with my worldview as it speaks to how you go about building wealth long term, setting long term goals, aggregating different exposures into something that's customized to your financial profile. To me, that's all adjacent to the core of our business and who we interact with on a daily basis. But again, far be it from me to tell someone what they can and can't do, how they can and can't invest their money or speculate with their money, for lack of a better word, and from an issuer perspective, what they can and can't offer to the public.
I think that's extremely well said, and I largely agree. But let me ask you this, because you head up fund sales and strategy at an ETF issuer. And so in your case, you're in charge of getting ALPS's ETFs into the hands of investors. And I'm curious, do all of these gambling type products coming to market, does that make your job easier or harder? Because on one hand, I could make the case that it makes it easier because you can speak to the longer term value proposition of your ETFs, right? As a contrast. On the other hand, this is creating a lot of noise in the market. And so, whatever message you have, whatever message ALPS has, you can make the case that's getting drowned out by all of this other hype and everything else going around. How are you thinking about that?
Yeah, it's a really good question, and it's almost philosophical, and there's a couple ways to look at this. Yeah, there is the risk with all of the noise and all of the focus on leverage, single stock ETFs, income-based single stock ETFs, prediction markets, some version of gambling in the ETF wrapper, that the sort of foundational concepts around long-term allocations and investing gets drowned out. I think that is a challenge for a firm like ours. The good news is, in some ways, we don't necessarily play in that sandbox very much. A lot of the users of some of these products aren't necessarily the advisors that we're interacting with or that we're looking to deliver solutions to on a day in and day out basis. I would posit that a lot of the activity and action, if you will, in some of these categories is more so in self-directed and or retail investment. And that's not necessarily the type of investors that we engage with, that we market to, that we solicit to. And so in many ways, it's almost happening in parallel to what we're doing on an ongoing basis. Then there's the other part of it, Nate, where in some ways, the opportunity for us to distinguish ourselves from all of that noise, all of that speculation, all of that risk is to bring traditional investment vehicles to advisors backed by sound research, sound processes, durable long-term strategies, and in some ways distance ourselves from some of the hullabaloo. And in that way, I think that creates an opportunity for a firm like ours to establish credibility and level set with advisors or allocators who we're engaging with, that we're not bringing them the next flavor of the month. We're not bringing them the next quote unquote gambling product. What we're bringing them, we believe, are well-crafted thematic strategies, well-managed, durable, long-term, actively managed strategies, or factor-based investment strategies that help them achieve their clients' goals. So in my mind, it sets you up as an asset manager, as a distribution force, to bring real value to advisors and allocators who might be overwhelmed by some of that noise and some of that quote unquote innovation that's taking place in parallel.
I'm really glad you brought up that latter point just in terms of how you're thinking about product development, because it was interesting. So I was looking this morning and I see that ALPS, thus far this year, if I have this right, has only launched one ETF. That's the Nautilus SMR Nuclear and Technology ETF. That was earlier in the year. But my point is, Paul, ALPS has been very meticulous in what is being brought to market. And so I'd love to have you talk more about that. Like, how are you approaching new product ideas? Because clearly you don't have the spaghetti cannon out. You're not just firing things at the wall.
Yeah, so you have 26 ETFs at the moment, and that in an organization like ours, where we don't have 400 wholesalers across the country, channelized and regionalized to a very small geographic footprint, we run pretty lean from a distribution perspective. We try to be really creative in how we engage with a large population of varied advisor types and allocator types. And so naturally, you have this balancing act where, because ALPS has this heritage in the servicing side and we still have a robust servicing business, we have, I would say, a pretty consistent flow of solicitation as it relates to new product ideas. And we need to be very deliberate in how we go about expanding the lineup, because if you're, say, a salesperson in our distribution organization, you're covering home offices, or you're just covering advisors in a geographic footprint, and you've got this lineup of ETFs, and then you're constantly adding to it, and in some cases, to sort of borrow the example we've been talking about, more complex or sort of more nuanced or more risky strategies, you're always swiveling in your seat to try and focus on one thing or the other. And maybe you're overwhelmed by the amount of strategies that you have to support and the different ways in which you have to tell those different stories. And you might even run into situations where you're contradicting yourself with the same advisor inadvertently, where you're telling one story that in many ways is the opposite of the story that you're telling. And so I think that's some of how the sausage is made, in terms of us balancing the desire to continue to innovate and to meet advisors where they are, and of course draft on some key industry trends and find new big opportunities to grow our assets, while at the same time being, I would say, good stewards to our sub advisors who want us to support their products and want to grow their franchises within the ALPS lineup, and want the type of distribution, marketing, and other resource support that's necessary to help grow them. And so it's complicated. I don't envy in any ways the people who sit at firms with a wide range of products who are continuing to add, because it can be very complicated to keep track of all those investments, all of those opportunities, all of those quote unquote pipelines. And so that might be a diplomatic way of answering your question. But at a high level, we have to balance where we're at from a product perspective. Are we doing our best to support the existing products we have? And if we are, can we add layers to those products? And of course, is the product category an opportunity that's worthwhile from a sort of ROI perspective? And we do have a roadmap for new products that we're excited about, that we're working on. But at the same time, you have to be deliberate when you're running pretty lean, and you're being thoughtful and pragmatic about where you sit in the industry, where you sit in the league table, and where opportunities exist.
I think that's a tremendous answer. And what I pull out of what you just said actually is investor education, in that if you're an issuer and you're launching products, can you properly educate investors around that? And I love your point around, you may have issuers who, if maybe they don't believe in something, they're launching contradictory products. And so I bring that back to the education side. Like, how are you educating if you have, two different forces pulling back and forth, and you don't truly believe in what you're offering to investors? And this kind of gets into a concept Dave and I were talking about around just issuer trust. And, as an investor, as an advisor, who do you trust? And I think everything you said there, that can shine through, that you are being thoughtful with launches, and you believe in them, and you're tying them to market themes that you believe in. All of that is really important.
Yeah. You bring up a couple good points, Nate, because I do think that this idea that you want to see what people are launching and you want to mimic it, or you scrape filings and see what's in there, and then maybe you go and try and chase those opportunities, or draft on what other people are developing. I understand that, and certainly that's been a successful strategy for a number of firms. And again, I'm not in a position to criticize anybody's product development or distribution strategy, but I do think it's important to note that if you're a wholesaler or in the distribution side of the business, and you've got people working on product in a lab somewhere with beakers and Bunsen burners coming up with the next cool idea, and they're completely detached from what it means to go out and engage with an advisor, what advisors actually care about, what salespeople do on a daily basis, there can be situations where you develop and build and then launch an ETF without any perspective or feedback from the tip of the spear, which is sales. And that disconnect happens, and that can be problematic, because a sales guy can be very comfortable with a lineup or a product strategy, or see a great opportunity for it. But if a product that gets introduced to them and they're beholden to sell that, they're measured against flow goals or whatever it might be in that specific product, and they don't really believe in that, that comes through in terms of how they interact with advisors on an ongoing basis. And it can distract from their ability to actually move the needle on products that they do believe in, or products that do meet the market or do fit the market backdrop. And that's another part of the complex balancing act that asset managers have in this marketplace.
All right, this is perfect, because I think, inadvertently set us up to talk about some ALPS ETFs. And you're going to have a chance here to show how you think about markets and how that ties into the ETF offerings at ALPS. So if you don't mind, I want to jump into these three key market themes to watch in the third quarter. So ALPS recently published these. Listeners, you can go in depth on all of these themes at alpsfunds.com. But Paul, why don't I do this? Why don't I tee these up one at a time? You give us a quick snapshot. You can perhaps tie it into an ALPS ETF or two, if that works for you.
Love it.
Perfect. Okay, so the first theme is the electrification of everything. And this is obviously centered around the rising electricity demand from AI data centers and those sorts of things. So, talk more about this one.
Yeah, so this probably isn't new to you, Nate, and anybody who's been listening to our conversations on your podcast over the course of the past few months. It's something that's near and dear to our heart. We almost can't avoid talking about it because we think it's such a massive secular trend and is reverberating through the economy in such interesting ways that it's one of those topics that we'll probably have on our market themes now from here until at least the end of the decade, just because of how powerful the trend is. The explosion in electricity demand, partly from AI data centers, but then the knock on effect of rising electricity demand after a period of 25 to 30 years where electricity demand growth was pretty stagnant. And now we're seeing, depending on forecasts, increases annually of 5, 7, perhaps 8% or so in certain geographic regions. And so if electricity demand rises, you need more generation and you need more transmission, which means, of course, you need all of the inputs to those solutions. And that means not just the utilities who are at the heart of generation and transmission, but the raw materials that are at the heart of it. And the electrification of everything to us is anchored to ELFI, the ALPS Electrification Infrastructure ETF, which we've talked about a number of times, Nate, but also the other subcomponents of it, exposure to raw materials, exposure to clean energy, because that's going to be a big piece of the evolving nature of how we deliver and how we access electricity and the smart systems that are being built. And then, of course, in some ways, customizing your application of the electrification of everything theme to your client needs. If it's income orientation that you're looking for on top of an electrification of everything thematic approach, you can use things like energy infrastructure, AMLP, and ENFR to enhance yield, but also play on the same core tenets of the electrification of everything theme. So the idea, Nate, and you can go to our website, alpsfunds.com, and learn a lot more about how we think about that, some of the research we've done on it, white papers and the like. But at a high level, it's about building a mosaic of exposures tailored to your client's needs that give you the types of exposures that are critically diversifiers. You don't have a lot of exposure to the companies at the heart of this. And a lot of these big CapEx announcements that we see, $500 billion there, $1 trillion there, are actually earmarked in many ways for the services, the parts, the components, the technologies that these companies provide. So in many ways, as we've said before, it's picks and shovels of the quote unquote AI gold rush and the electrification gold rush.
All right. So, electrification of everything, that's theme one. Next theme, global resource scarcity and hoarding. And we've talked about this before in the past a little bit. I think this ties into the Iran conflict and everything going on there. So, what should investors be paying attention to with this?
So I think what people are struggling with as it relates to the Iran conflict, of course, is there's daily headline noise. One day we got an MOU, the next day we're firing missiles at each other and vice versa. And so I think the period we're in with headline volatility, uncertainty has impacted commodity prices naturally. The Strait of Hormuz being closed down and the sort of prior level of 20 million barrels a day moving through there has evolved, and the market's adapted to it, and that has influenced portfolio decisions. But then the next phase, assuming we get some sort of resolution, clean, messy, or otherwise, what does the next day look like? What does the next 5-10 years look like as a result of that? And our expectation is that you're going to see infrastructure build out that's going to allow countries to insulate themselves from this very critical choke point economically. And that's going to require a lot of natural resources. It will also require a lot of infrastructure investment to allow countries to stockpile the critical resources, critical minerals, critical fertilizers, and the like, that will allow them to once again insulate them from future geopolitical shocks. And so the idea is we're at a moment now where clearly resources are scarce as a result of a shutdown and a closure of a critical choke point. But then as a result of this, the likelihood is that countries are going to be spending in order to secure a different energy and resource destiny in the future. And we think that's going to put long-term pressure on commodities markets and, of course, put upward pressure on a lot of the companies that are out there mining for, refining, exploring for these various natural resources. So that's why in that section, you've got pure play commodities portfolios like SDCI, which owns the futures themselves, as well as a global actively managed portfolio of natural resources equities, CCNR. And so the idea is we've got the current state. We don't know what the future state looks like, but reading the tea leaves, it looks like we're going to have a lot of investment that's going to take place and will put additional pressure on already fraught global commodities markets.
All right. And then the third theme, which again, you and I have talked about this before as well. And I think both of these are interesting. They're tied together, but I'll offer both of these up: IPO mania and market concentration. And so what would be your snapshot here in terms of investor considerations?
Yeah, to your point, this isn't new. We're not the first ones to talk about market concentration. You turn on CNBC or Bloomberg or whatever financial media you digest on a regular basis, and it seems to be all everyone wants to talk about: the concentration of earnings growth in small segments of the market, the implications for investors, and it feels like, at least so far in 2026, what's playing out is a somewhat broadening trade in certain categories of the market that's benefited various methodologies, whether it's value relative to growth, whether it's equal sector weight versus market cap weight. And our thought here is, if you're looking for ways to insulate client equity allocations from the concentration in Mag 7, concentration in AI names, concentration in semiconductor names and the like in your market baskets as defined by cap weighted indexes, whether it be the S&P 500 or the NASDAQ 100, there's other ways to think about your equity allocations. Doesn't have to be a wholesale replacement, but can be an augmentation. So we've talked about equal sector weighting through EQL, which has very different risk reward dynamics than, say, an equal stock weighted approach. SDOG, which is one of those legacy dogs of the Dow strategies, which equal weight sectors, but also has a yield orientation and a cyclical value bias. And then B4, which is a combination of GARP and quality screening, equal stock weighted, and gives you a very different factor orientation in the market. So the idea is, here's a playbook for these different market themes that we're seeing based on the research that we do and our multi-asset research team's outlook. And here are some things to think about as it relates to your investment policy committee meetings, your investment allocation decisions, your rebalances at that asset allocation level, which hopefully will inform not just how you go about allocating your client portfolios, but critically, how you talk to your clients about the current market moment. Because one thing we found, Nate, is that advisors do value thought leadership to tie it all back together and investor education. And they often appreciate having a different perspective than they're used to getting on the market, on key themes, and on allocation decisions.
100%, which is why I like this. And I think all of that's well said. By the way, as you were going through that on the IPO side, I was thinking back to our last conversation. And if you remember, we were talking about SpaceX. And since that time, what's happened? You know, SpaceX spiked up 50% and then fully round tripped back down to the IPO price. Just a good example of something to be aware of. We always talk about, we don't have a crystal ball. We're not making any market predictions, but I think a good shorter term example of some of the things that we're seeing in the market right now.
Absolutely. And that's the challenge that makes the business of being an advisor to clients so challenging, because you have the market dynamics, which are challenging in and of themselves. And then you have the behavioral finance aspects, which are also very challenging. And so when you have an IPO, which is the largest in history, sucking all of the oxygen out of the room from a headline perspective, from a market coverage perspective, it's inevitable that clients at, the proverbial cocktail party or the taxi driver analogy that we used to hear during the dot-com era, that's going to bubble up. And so how do you have those conversations without making predictions, but also weave in market concepts that help in some ways alleviate some of those behavioral biases that we all have, not just at the client level, but in the industry writ large?
Well, Paul, excellent stuff this week. I always enjoy visiting. Thank you very much for joining me.
Likewise, Nate, you're the man. I'll see you next time.
Thank you. That was Paul Baiocchi, Head of Fund Sales and Strategy at SS&C ALPS Advisors. That'll do it for this week's ETF Prime. Build your ETF expertise and separate yourself from your peers by registering for the ETF Institute Certified ETF Advisor Program. You can learn more at cetf.org. Next week, I'll be joined by Graham Day, Chief Investment Officer at Innovator ETFs. And we'll obviously be talking defined outcome ETFs, but we're also going to talk about how the firm is continuing to innovate in this particular category. And we'll actually be spotlighting a brand new fund along with that. So it should be a fantastic conversation. Until then, have a great week, everyone.
ETF Prime is hosted by Nate Geraci, president of OTR Media, LLC. Nate is also president of investment advisory firm Nova Diaz Wealth Management. While OTR Media and Nova Diaz are related by common ownership, they are separate and distinct entities, and anything discussed on this program should not be construed as an official statement by Nova Diaz. This program is for informational purposes only and does not constitute investment advice. Investing in ETFs involves risk, including possible loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Some guests appearing on this program may also be financial sponsors of ETF Prime. OTR Media and Nova Diaz are not affiliated with Vetify or any of its affiliates. Vetify's participation in this program should not be construed as an endorsement or an indication by Vetify of the value of any OTR Media or Nova Diaz product or service. Visit etfprime.com for more information.